Imagine you are watching a dam hold back a reservoir. The water pressure behind it is immense, historic even, and the concrete is starting to show hairline cracks. Now imagine that instead of reinforcing the dam or carefully releasing some of that pressure, the engineers in charge decide to take a sledgehammer to the control room. They don't fix the leak. They just smash the instrument that measures it. That is precisely what happened in the silver market during the final days of December 2025. Silver, the white metal that is simultaneously a store of wealth and the industrial backbone of the AI and green energy revolutions, was on a screaming rally, flirting with all-time highs above $84 an ounce. It was a move driven not by speculative mania, but by a terrifyingly simple fact: the world is running out of it. Then, in the space of a single holiday week, the Chicago Mercantile Exchange, the largest futures exchange in the world, stepped in and changed the rules of the game. They raised the amount of cash required to hold a silver contract not once, but twice. The result was a controlled demolition, a flash crash that wiped nearly 15% off the price in a matter of minutes, liquidating over 67 million ounces of paper silver. The mainstream financial press called it profit-taking, a normal year-end correction. But if you look at the incentives, the timing, and the geopolitical chessboard, a far more uncomfortable truth emerges. This wasn't a market failure. It was a mission. And understanding the real plan behind that crash is the only way to understand where the global economy is heading next. By the end of this story, you will see that what happened in Chicago was not about cooling down a hot commodity. It was about trying to decouple a financial derivative from a physical reality that the West is rapidly losing control of. To understand why the dam was about to break, you have to understand what silver has become. For centuries, we thought of silver as a cousin to gold, a thing of coins and jewelry. That is a dangerous oversimplification. Silver is the most electrically conductive metal on Earth. It is thermally efficient and antimicrobial. You cannot build the modern world without it. And we are currently trying to build two new worlds at once. The first is the green energy transition. Every single solar panel requires a thick paste of silver paste to pull the electricity off the cell. As we build out massive solar farms to replace fossil fuels, we are burning through millions of ounces of a finite resource. The second is the artificial intelligence revolution. Those data centers you hear about, the ones running ChatGPT and training the next generation of large language models, they generate insane amounts of heat. Engineers are increasingly turning to silver-based cooling solutions and high-density servers that require flawless conductivity. Add to that the electrification of the entire automotive fleet, which uses twice as much silver as a gas-powered car, and the 5G build-out, and military applications from missile guidance to satellite communications. The math stops working. In 2025, the world consumed roughly 300 million ounces more silver than it produced. That is a deficit the size of a major mine's entire lifetime output. So, with demand exploding and supply chains tightening, the price did what it logically should do. It went up. It pushed past $50, then $60, then flirted with $85. But here is where the logic of the physical world collides with the architecture of the financial one. Most people don't own physical silver. They own a claim on it through the futures market, specifically the COMEX, which is owned by the CME Group. The futures market was never designed to facilitate the delivery of massive amounts of metal. It was designed for farmers and jewelers to hedge risk. Today, it is a highly leveraged casino. For every physical ounce of silver sitting in a COMEX vault, there are likely dozens of paper contracts trading on top of it. It is a fractional reserve system for metal. And as long as everyone is just trading paper back and forth, it works. But when the price starts to reflect a genuine physical shortage, when industrial users in China and India start bidding up physical metal to a premium, that paper pyramid becomes unstable. The people who sold silver they don't have, the big speculative short sellers start to panic. They need to buy back those contracts before the price goes to the moon. The CME saw this happening. They saw the silver squeeze narrative gaining traction, and they saw the physical market in Shanghai decoupling from the paper market in New York. By late December, the Shanghai premium was over $8 an ounce. That is a signal that the physical metal simply isn't flowing west anymore. So on December 26th, and then again on December 30th, the CME deployed the sledgehammer. They raised margin requirements by nearly 50% in a single week. For a leveraged trader, this is a death sentence. It means you have to come up with significantly more cash overnight, or your broker will liquidate your position. In the thin holiday trading volume, with liquidity sucked out of the market, this triggered a cascade. It was a liquidation event so violent that it created a flash crash, taking the price from the mid-80s down to around $70. The official story is risk management. They were just protecting the integrity of the clearinghouse. But timing is everything in strategy. Why do it on a holiday week when liquidity is lowest, maximizing the crash? Why do it just days before a massive known geopolitical event? Because on January 1st, 2026, just hours after this engineered sell-off, China's new export restrictions on silver took full effect. Let that sink in. The world's largest refiner and holder of silver, a country that accounts for a huge percentage of global supply, effectively locked its doors. They didn't ban production. They banned exports, requiring government permits to move metal out of the country. This is not a trade policy. This is a stockpiling strategy. Now we get to the part of the plan they don't want you to see. The crash was not an accident. It was a repricing mechanism designed to serve two masters. First, it was a bailout for the big institutional shorts. Major banks and funds had placed massive bets that silver would stay cheap. When the physical deficit became undeniable, they were sitting on billions in potential losses. The margin hike forced the retail longs, the small traders who were betting on the squeeze, to sell at a loss to cover their margins, providing liquidity for the big players to escape their positions. It was a transfer of wealth from the retail speculators to the institutional hedgers, executed under the guise of regulatory prudence. But there is a deeper, more strategic layer here that has nothing to do with Wall Street and everything to do with Washington and Beijing. For decades, a quiet war has been waged over the price of silver. Analysis of historical price action suggests that if you strip out the artificial selling pressure during London trading hours over the last 50 years, gold would be trading at multiples of its current price. Silver has been suppressed because the dollar was the world's reserve currency, and the West wanted cheap raw materials. But that game is ending. In 2025, the United States Geological Survey proposed something radical. For the first time, they recommended adding silver to the official list of critical minerals. This is not a symbolic gesture. It is a national security alert. A critical mineral designation unlocks government funding for stockpiling, fast-tracks mining permits, and treats the metal as a strategic defense asset rather than just a pretty rock. The U.S. suddenly realizes it imports over 70% of its silver, and the refining capacity is concentrated in a geopolitical rival. The crash, therefore, serves a second purpose. It keeps the price low enough for the Treasury and the Defense Logistics Agency to potentially start buying physical silver for a strategic reserve without spiking the market. It gives the West a chance to play catch-up in a stockpiling race they are losing. But here is the uncomfortable math, the reality that no margin hike can fix. You cannot print silver. The CME can change the rules of its casino, but it cannot make metal appear in its vaults. The evidence of this is the great divergence that the crash created. After the CME smashed the paper price on December 30th, the physical market in Shanghai did not crash. It held its premium. Industrial buyers in Asia looked at the lower COMEX price and said, "Great, we'll take delivery." But the COMEX is not set up to handle a mass exodus of physical metal. If too many futures holders demand the actual silver bars instead of cash, the system could face a liquidity crisis, a default on paper claims. This is why the exchange acted. They had to break the speculative fever before the redemption window broke the bank. Now, look at the timeline of history. This exact playbook has been run before. In 1980, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical metal, and the price exploded. The exchange responded by changing the rules, raising margins, and eventually prohibiting new positions, which caused a catastrophic collapse known as Silver Thursday. The same tactics were used during the alleged manipulation schemes by JP Morgan traders, who were later convicted of spoofing, placing fake orders to create a false impression of supply. The playbook is old, but the stakes are brand new. Back then, it was about a family fortune. Today, it is about control of a metal that determines who gets to build the future. Consider the irony of the situation. For years, conspiracy theorists claimed JP Morgan was secretly manipulating the silver market. And while the bank did pay nearly $1 billion in fines for manipulative trading practices between 2008 and 2016, the reality is that the manipulation is bigger than any single bank. It is systemic. it is structural. As one analyst pointed out, JP Morgan may have simply been acting as an intermediary for a much larger client who had a vested interest in a low price, the People's Bank of China. Think about that. For years, China needed to import massive amounts of silver to build its economy and back its currency. They had every incentive to keep the price low while they accumulated. They used the Western financial system, with its deep paper markets, to suppress the very asset they were buying in the physical world. But now, the accumulation phase is likely over. China doesn't need to suppress it anymore because they own it. They now want the price to reflect the reality of the deficit. The export ban is the ultimate signal that the buyer is no longer hungry. The seller is now in control. The losers in this regime shift are the Western financial institutions that are still short, still betting on the old world where paper dictates price. The winners are the ones who understand that the margin hike in December was the last gasp of a dying system. The physical market is now the only market that matters. The U.S. government's reclassification of silver as a critical mineral means that even if the price stays suppressed for a few more months, the long-term bid is locked in. Defense contractors need it. Solar manufacturers need it. The AI build-out cannot happen without it. This creates a scenario where the demand is inelastic. These industries will pay whatever it takes to get the metal because their products don't work without it. So, where does that leave us now? The crash served its tactical purpose. It wiped out leverage, reset sentiment, and gave the big players a chance to cover. But it did nothing to solve the 300 million ounce deficit. It did nothing to bring a new mine online, a process that takes over a decade. And it did nothing to reverse China's export ban. What it did was create a window for the West to quietly accumulate physical metal at a discounted paper price before the decoupling becomes permanent. If you are a nation-state looking to secure your supply chains, you don't buy when the price is at the peak of a panic. You buy when the exchange has artificially crushed the price for you. The question is, are they buying? We may not know for months, as stockpiling is often done in secret, but the incentives are clear. The U.S. has designated the metal as critical. Critical things must be secured. Securing them requires buying them. The narrative you heard on New Year's Eve was that silver speculators got burned, that the rally was overblown. But peel back that layer and you see the mechanics of a system fighting for its life. The CME used its regulatory authority not to calm a market, but to reset the playing field. They are trying to convince the world that the paper price is the real price. But the real price is being discovered in Shanghai, in the premiums dealers are charging for coins, and in the frantic, quiet stockpiling by industrial giants. We are watching the last dance between a financialized paper economy and a tangible, scarce physical reality. And as with all last dances, it is messy, it is strategic, and it is happening right under our noses. If this deeper look at the hidden mechanics of global power made you think differently about what you thought you knew, hit that like button. It helps more people see past the headlines. Subscribe if you want to understand the strategy behind the story, not just the noise. And leave a comment. Do you think the paper market can continue to control the physical price, or is the decoupling inevitable? We read them. Thanks for watching. Because in a world of infinite paper, the only thing that remains scarce is the truth.